This income comparison analysis reveals why sophisticated investors choose options selling over traditional strategies. The primary visualization shows three distinct income streams with their annual return potential. Options selling generates 12 to 18% annual returns on deployed capital, significantly outperforming S&P 500 buy-and-hold strategies that average 10 to 12% annually. Traditional dividend investing delivers only 2 to 4% yields. The secondary analysis demonstrates income consistency advantages, with options selling providing monthly theta decay income versus quarterly dividend payments that create irregular cash flow. The capital efficiency metrics show options sellers can achieve 15 to 18% returns while maintaining lower risk profiles through systematic premium collection strategies. This statistical probability analysis exposes the fundamental mathematical advantage that professional options sellers exploit systematically. The primary chart displays options expiration statistics, showing 85% of all options expire worthless, creating a powerful statistical edge for premium sellers. Only 15% expire in the money, meaning sellers win on the vast majority of transactions. The time decay visualization demonstrates theta acceleration patterns, showing linear decay transitioning to exponential acceleration in the final 30 to 45 days before expiration. The risk-adjusted returns comparison table reveals options selling strategies consistently achieve higher Sharpe ratios than buy-and-hold approaches, delivering superior returns per unit of risk through systematic probability exploitation. This sobering failure analysis quantifies why most options traders lose money and how to avoid their systematic mistakes. The account survival timeline shows 90% of options traders lose money within 12 months, with the average account destruction occurring in 6 to 8 months. The behavioral failure breakdown reveals 4 primary causes. Overtrading accounts for 40% of failures as traders chase profits instead of following disciplined processes. Undercapitalization represents 30% as small accounts cannot weather normal drawdowns. Strategy mixing causes 20% of failures as traders abandon proven methods for complex alternatives. And emotional decisions account for 10% as fear and greed override systematic approaches. Understanding these failure patterns enables successful traders to implement protective measures. This comprehensive performance matrix demonstrates why options selling strategies consistently outperform traditional investment approaches. Buy-and-hold investing generates approximately 10% annual returns through market appreciation and dividends. Covered call strategies enhance returns to 13 to 15% annually by collecting premium income on existing stock positions. Cash-secured put strategies achieve 12 to 16% returns on deployed capital by generating income while waiting for favorable stock entry prices. The wheel strategy combines covered calls and cash-secured puts to achieve 15 to 18% annual returns through systematic premium collection and stock ownership rotation. The monthly income generation analysis shows option strategies providing consistent cash flow versus the irregular income patterns of traditional investing. This stock selection analysis identifies optimal targets for professional options selling strategies based on premium collection potential and underlying stability. Dividend Aristocrats provide ideal characteristics combining consistent option premiums with dividend growth, including Apple with 25 to 35% implied volatility, Microsoft with 20 to 30% for, Johnson & Johnson with 15 to 25% for, and Coca-Cola with 15 to 20% for. High implied volatility sectors offer enhanced premium collection opportunities. Technology stocks average 25 to 35% for. Biotechnology names reach 40 to 60% for during development phases, and financial sector stocks maintain 20 to 30% for. The sector analysis reveals optimal combinations of premium income and underlying stock quality for systematic selling strategies. This professional account structure analysis reveals the capital requirements and allocation strategies necessary for effective options selling. The minimum viable account analysis shows $25,000 as the threshold for proper diversification and risk management. Professional allocation models deploy 60% of capital in active positions, maintain 20% in cash reserves for assignment management and market opportunities, and hold 20% in opportunity funds for volatile market periods. Position sizing protocols limit individual trade risk to 2 to 5% of total account value, ensuring no single position can devastate the portfolio. Diversification requirements call for 8 to 12 simultaneous positions across different sectors and expiration cycles to reduce correlation risk and smooth income generation. This behavioral analysis contrasts retail trader psychology with professional options seller mentality, revealing why mindset determines success or failure. Retail traders typically buy calls and put seeking large profits from small investments, exhibit home run mentality expecting massive gains from individual trades, and make emotional decisions based on fear and greed rather than systematic processes. Professional sellers embrace the opposite approach, selling premium to collect consistent income, focusing on high-probability small gains that compound over time, and following mechanical processes that remove emotion from trading decisions. The psychological indicators show successful sellers develop patience over instant gratification, process discipline over emotional reactions, and long-term wealth building over get-rich-quick schemes. This time decay analysis illustrates the mathematical foundation of options selling success through theta exploitation. The primary visualization shows options value erosion from 60 days to expiration, demonstrating linear decay in early weeks transitioning to exponential acceleration in the final 30 to 45 days. Professional sellers target this optimal window where time decay accelerates while maintaining reasonable premium collection. The Greek's interaction display shows the relationship between delta, theta, and vega throughout an option's life cycle. Delta measures price sensitivity, theta quantifies time decay rate, and vega indicates volatility sensitivity. Understanding these relationships enables sellers to optimize entry timing and manage positions effectively as market conditions change. This probability-based analysis reveals the mathematical approach to optimal strike selection for consistent premium collection. The bell curve distribution shows probability bands for different delta levels, with 15 to 20 delta short puts offering 85% success probability and 15 to 30 delta covered calls achieving 80% success rates. These probability zones provide the optimal balance between premium collection and assignment risk. Premium collection targets focus on generating 1 to 2% monthly income relative to deployed capital, creating annualized returns of 12 to 24%. The risk-reward optimization matrix demonstrates how proper strike selection maximizes income while minimizing assignment probability, enabling sustainable long-term success. This event-driven analysis exposes how options sellers exploit implied volatility patterns around earnings announcements and market events. The primary chart displays typical implied volatility behavior, showing 30 to 50% increases before earnings announcements followed by immediate volatility crush post-announcement regardless of stock price movement. Professional sellers exploit this pattern by selling premium during elevated 4 periods and benefiting from rapid time decay acceleration. The seasonal volatility calendar identifies recurring patterns, elevated volatility during earnings seasons, market stress periods creating systematic opportunities, and holiday periods with reduced trading activity. Event timing strategies enable sellers to maximize premium collection during high volatility windows while avoiding assignment risk. This professional allocation model demonstrates optimal portfolio construction for systematic options selling success. The primary allocation shows 60% dedicated to covered call positions on quality, dividend-paying stocks and 40% allocated to cash-secured, put strategies targeting attractive entry prices. Diversification requirements mandate 8 to 12 simultaneous positions distributed across different sectors to avoid correlation clustering. The sector allocation prevents concentration risk by limiting exposure to any single industry. Technology positions should not exceed 25%, financial sector exposure should remain below 20%, and healthcare allocations should stay under 20%. Position balance analysis shows optimal timing for rolling positions, managing assignments, and maintaining consistent income generation throughout market cycles. This comprehensive risk control system outlines professional protocols for protecting capital during adverse market conditions. Maximum drawdown limits establish 10 to 15% portfolio stop-loss thresholds, forcing position closure and strategy reevaluation when losses exceed acceptable levels. Assignment procedures detail systematic approaches for managing stock ownership when puts are assigned or calls are exercised, maintaining quality holdings, implementing defensive covered calls, and establishing clear exit criteria. Black swan protection protocols include portfolio hedging during extreme market stress, maintaining higher cash reserves during uncertain periods, and reducing position sizes when volatility exceeds normal ranges. The monitoring dashboard tracks key risk metrics including portfolio beta, sector concentration, and time decay rates. This psychological analysis identifies mental characteristics that separate successful options sellers from failures. Patience over greed represents the fundamental mindset shift. Successful sellers accept consistent small gains rather than chasing large profits, understanding that systematic premium collection compounds wealth over time. Process discipline over emotional decisions requires mechanical execution of proven strategies regardless of market sentiment or recent outcomes. Long-term wealth building over get-rich-quick mentality focuses on sustainable returns rather than spectacular but unsustainable performance. The success correlation analysis shows direct relationships between psychological discipline and trading outcomes. Traders who follow systematic processes achieve significantly higher success rates than those making emotional decisions based on market movements or recent results. This advanced strategy analysis presents professional techniques for managing complex situations and accelerating income generation. Rolling strategies enable position defense and time extension. Rolling short options to longer expiration dates when assignments threaten, adjusting strikes to maintain optimal probability profiles, and converting losing positions into winning scenarios through systematic adjustments. Position repair techniques address underwater situations, establishing protective spreads to limit losses, implementing recovery strategies for assigned positions, and maintaining income generation during adverse market conditions. Income acceleration methods include compound strategies for experienced sellers, reinvesting premium income into additional positions, scaling successful strategies across larger capital bases, and optimizing tax efficiency through strategic timing of gains and losses. This scalability analysis demonstrates how institutional investors and sophisticated individuals implement options selling strategies across varying account sizes. The account progression model shows successful scaling from $25,000 to $1 million while maintaining 15 to 18% annual returns through systematic position management and risk control. Institutional adoption patterns reveal how pension funds, insurance companies, and hedge funds integrate options selling into broader portfolio strategies. The educational pathway charts progression from beginner to professional level, starting with covered calls and cash-secured puts, advancing to complex spread strategies, and ultimately implementing institutional quality systematic approaches. Professional development requires continuous education, systematic backtesting, and gradual complexity increases as experience and capital grow over time.